Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Julian Emanuel of EvercoreISI joins us around the table. Julian, good morning to you.
Good morning.
I'm going to use your words to set up the first question. The sentiment shift during February to the type of pessimism more consistent with major bottoms after protracted sell-offs rather than so near all-time highs is nothing short of extraordinary. We're 5% away from all-time highs, and yet pessimism is falling off a cliff right now. There is literally no confidence at the moment from business leaders, from consumers, from the people we speak to day after day. What gives? Either sentiment needs to catch up or the market needs to catch down.
Well, two things just to highlight how extraordinary it really is. We looked at bearish sentiment and at these levels, the average drawdown from the high is 29% when you get these levels. The lowest drawdown was 13%, and as you mentioned, less than 5%. It's really what it is, you know, again, as you pointed out earlier, there was not an expectation that we were going to get what we've gotten this morning, that the tariffs are actually on and in place. And to be fair, our house view is that they will not last that long because the damage to the economy is too great. But you know, this is classic financial market risk reward. And when you talk to investors, they don't see the potential reward outweighing the risks of being aggressive here.
We started the show saying that people who thought that these tariffs were just a negotiating tool are now saying it's not going to last very long, and they're still just a negotiating tool. At what point does it become irreversible in terms of the effect on markets? The idea that even if they stay on for a prolonged period of time, that requires some sort of response in supply chains, in growth expectations, in, frankly, trade relationships globally?
Well, you're certainly starting to see it. And I think the uncertainty is also a function of the geopolitical chess pieces being reconfigured as well. And again, that ISM data, you know, incredible. Prices paid elevated, you know, in terms of precautionary buying of goods. And then, of course, new orders falling off the cliff because you already bought the goods. There's a psychology aspect to this, which is what is very important. And I think it's also interesting because if you look back to the original trade war in 2018, when the stock market backed off, President Trump's rhetoric backed off, okay? The danger here is particularly when you look at 5,700 in our view is important because that's where the market was on Election Day 2024. And he's never had what we'd call an adverse mark to market in either Trump 45 or obviously Trump 47. Does the rhetoric change? And the market is not so certain of that.
You mean the test of the Trump put and whether that actually still is in effect? If it isn't in effect, what's the downside? I mean, are you becoming actually bearish, or are you just saying that there's more heightened uncertainty on both sides?
So we have viewed 2025 as a continuation of the rally, but with the different character of what we call 3 steps forward, 2 steps back, heightened volatility. So whatever the baseline of volatility was in the VIX last year, 14, 15, that number is now more consistent with the long run average of 19. Could you get to a downside where growth sub 2% and inflation sticky towards 3%? Without a recession causes a test of a number like 5,200, it's certainly not outside of the realm of possibility. We'd treat that as a buying opportunity. But when you have this kind of uncertainty, you have to expand how you're thinking about the tails.
Julian, we're only 6 weeks into this administration, though. If he was to back off now, then he's the boy who cried wolf for every other date on that calendar.
Yeah, and that's part of the fact that, you know, again, what did he learn from the first administration is that history tells you, regardless of circumstances, you're likely to lose the majority in the House in 2018. And we know the way politics works. They'll start running for the 2026 campaign this fall. You've got to front load everything. So the accumulated uncertainty is in these first few weeks. And it's sort of, let the chips fall where they're going to fall.
Would you buy stocks here?
We want to see a little bit more despair, quite honestly, consistent with that bearish reading. Yes, the market has acted as if it is approaching despair, but to us, when you think about all the catalysts, you think about that speech tonight where clearly he's going to talk tough, no question about it. You think about the potential for the government shutdown on March 14th, which matters now because of the reception of Doge. The risk is not quite balanced versus the reward at this point.
Fed on March 19th. How does all this change their meeting in a couple of weeks' time, 2 weeks tomorrow?
I don't know that the rhetoric is going to deviate that much. You might see downgrades to their economic forecast a little bit. If you're thinking about market confidence, you might want to see a slight downgrade to the inflation forecast, but you're not likely to see it because we really don't know what the effect of the tariffs are. The bond market's telling you that the inflation problem is not the problem, it's growth. But the statistics don't confirm that yet.
Final question, year-end price target, 6,800, correct?
It is.
For a lot of people, looking back to the election in early November, they made the argument that the overall policy mix was positive for stocks, pro-risk, pro-growth. The trade was going to be a tricky part of it, but it was one piece of a much bigger policy platform. Is that still the correct way to look at this country?
It is. But again, there has to be an understanding of how the pieces fit and a sensitivity around the fact that words clearly, even before the actions have been implemented, have consequences. And, from our point of view, our guiding light is that earnings growth still looks 9% to us. We have not moved. We don't anticipate that's going to come off it.
Julian, appreciate your time. As always, sir.
Thank you.
What a start to the week. Julian Emanuel there of EvercoreISI. Of Raymond James joins us now for more. Ed, welcome to the program, sir. We said just moments ago that the people who didn't believe this day would come now believe this day won't last very long. Ed, what's your message for them?
My message is I feel like I've been the Paul Revere of tariffs all this year. Kind of the tariffs are coming, and no one has really believed me. I think that there is an element of this that is absolutely about negotiation, absolutely about using the economic strength of the United States to push our allies in many cases to make changes. And I think that's the base case. But I also have told folks here at Raymond James, expect a lot of these tariffs. If it's not at 25% permanently, does it come in at 5 or 10% permanently? Because bucket one is changing policy. Bucket two is having enough revenue to potentially pay for policies like the extension of the tax cuts in a couple of months here.
Ed, what kind of timeline are you giving for some of these exemptions or potentially the lowering of the tariff rate?
It's really hard to give a timeline because most, if not all, of this tariff authority is solely within Donald Trump's discretion. He can decide at 12 o'clock today to take it all off. He can decide at 12:01 to put it all in. When I've talked to clients at Raymond James, they're expecting there to be exemptions on medical equipment, things for humanitarian aids, things that are going to be specifically important to consumers like energy. We do have a lower energy rate here from Canada. Donald Trump very much cares about inflation, but he also wants to be able to show, as we have the joint session of Congress, I'm not calling it the State of the Union tonight, where he is going to push hard. And we're going to have reciprocal tariffs come April 1st, April 2nd, more tariffs. This is a steady drumbeat that's going to happen, and Donald Trump turning it on, turning it off is going to be part of the negotiation.
What's driving these tariffs is really the fentanyl deaths. Donald Trump has talked about that. The president, as well as officials, have spoken to me about that as well. Kellyanne Shaw, a negotiator in Trump 1.0, said on Bloomberg television earlier this morning, this is the new normal. They seem to be swapping what maybe you'd use sanctions for tariffs, and this is the new realpolitik. In that sense, then, how do you decipher what's negotiation for national security and what's going to be a revenue raiser?
That's up to Donald Trump as well. I mean, I think, Anne-Marie, you're absolutely right. Donald Trump has been very concerned about fentanyl, and I think with a conversation about China, a conversation about Mexico, absolutely part of the conversation, absolutely a huge issue that needs to be dealt with. When I talk to my Canadian clients, they're not really understanding why fentanyl is as big of an issue. There has been shipments across the Canadian border, but it doesn't actually happen all that often, especially compared to others. Donald Trump is going to use whatever excuse he has to push forward these tariffs, trying to get those changes. And it's not quite clear exactly what he asked for. When I talk to a lot of my contacts, foreign leaders are concerned about trying to strike a deal with Donald Trump, only to be embarrassed. Look at the Oval Office meeting with Zelensky last week. If you are a foreign leader, you say, do I actually respond to these, and how aggressively do I respond to these? Or if I get to the White House, I think I have a deal, and it just devolves from there. That's a real concern globally.
Ed, has there been a shift in tone from your clients in terms of their belief in just this being sequencing, that the hard stuff comes first and the good stuff comes later?
So I'm right now at the Raymond James Institutional Investor Conference. We have over 1,000 companies and investors, and every single conversation I had last night was, is this going to be worse than we expected? We don't have a lot of conviction. There is a lot of angst out there. You go company by company. They haven't really disclosed exactly what the impact for them, oftentimes because they did not think this was going to happen. And so that uncertainty is a huge shift in tone. That kind of concern that this could last is a huge shift in tone. They're hopeful that this comes off, and I think the base case is that 25% on Canada and Mexico does not last for very long. But as soon as that gets pulled off, what happens with Europe? What happens with the rest of the world? Those concerns, which were kind of completely pushed aside, Lisa, are front and center in every conversation I'm having right now at our Raymond James conference.
Ed, how much at those dinners were people saying that they just are putting everything on hold? This is just a time to wait and see, and any plans for investment, any plans for deals are just going to have to wait until there is some more clarity.
Yeah, I think for investors, most need to be fully invested, so they are trying to figure out where they can hide. What are the opportunities for them to not get kind of hit by a buzzsaw on transactions and M&A, on IPOs? That is a lot more frozen or sluggish than expected, and that was a big theme as well in my conversations, like what was expected after November and into December and that euphoria. People are like, we need to understand where rates go, where tariffs go, what tax policy is. The long list of Trump concerns is the new conversation I'm having with clients at Raymond James.
It's a big change from where we were a few months ago. Ed, appreciate your time, sir. Thank you. Ed Mills there of Raymond James. Let's turn to foreign exchange. Traders digesting President Trump's 25% tariffs on Mexico and Canada. Kit Juckes of SocGen writing this. This morning's shocker is the Canadian dollar is up. Despite tariffs arriving, Friday's Canadian jobs numbers might be important as the US ones. Kit joins us now for more. Kit, welcome to the program. Let's talk about that muted response, if we can call it that, in foreign exchange. Kit, what gives?
Well, I mean, the big response in the sense has been this is bad for growth in the United States. And you've heard some of that. The market's pricing in rate moves that it wasn't, or more rate moves that it was, and looking negative. We have seen no shift in consensus forecasts down in for US GDP growth yet. And we've seen a series of upward revisions to economists' forecasters for this year since September that drove the dollar higher. But what we're seeing is the market is going ahead away from the economists. The strategists are getting negative. The traders, the investors are nervous about what this means. So we have a weaker dollar, and that protects the Canadian dollar, where we've been talking about the tariffs for a while, and the Canadian Canadian dollar has been beaten up. But I do think it means that it puts more of a focus, in a sense, on growth in North America. What is the ISM service number going to look like tomorrow in the States? What are payrolls going to look like on Friday? And what are Canadian jobs going to look like on Friday? Because all this betting on more rate cuts faster is going to need some validation reasonably quickly to be able to sustain itself.
Kit, are you saying that people expected tariffs to be worse for the rest of the world than the United States late last year and early this year, and that story has shifted, and now people are thinking that based on where valuations are, this actually could be a bigger hit to the U.S. economic growth trajectory based on expectations than the rest of the world?
Yeah, look, I think we start from the U.S. exceptionalism position where we've been revising up U.S. growth forecasts for a long time, revising them down everywhere else, talking about how exceptional the U.S. is, and expecting higher rates than in other places, and watching the dollar get to extraordinary heights. So we're hypersensitive, if you like, to anything that suggests that actually the U.S. economy might really be able to slow. Now, whether it's going to slow as fast or as much as people are contemplating, what you have is a big position adjustment in the market, a growing awareness of the fact that foreigners own $65 trillion worth of U.S. assets, and if they get nervous, that really is a problem. And so, these stories are beginning to happen. The reaction in the market looks big relative to the news flow so far, but I guess that's what happens when you're at a turning point.
Kit, right now I'm looking at the euro that's actually at the strongest level going back to early December versus the dollar. Is this because of concerns about U.S. growth, or is this because of optimism if some sort of spending plan is laid out by Ursula von der Leyen today?
I mean, it's a little bit of both in the sense if you look at it, euro-dollar tracks the two-year interest rate differential painfully closely at the moment. And what's happened? Well, we've taken U.S. two-year rates down. So that's been the single biggest driver of that over the last few days. There is some optimism about the program. There would have been much more optimism into Europe if you'd had a sweeping win for a party in the German government elections last week. I can't remember how long ago it was now, that would have delivered an end to the debt brake that hamstrings their fiscal policy and is completely ludicrous. That would be a bigger game changer. Also, we're saying, we spent the last, 2 years in a 0.95, 113 range. Not a big range. We're just drifting up to the middle of it.
But Kit, what happens on April 2nd when potentially we get tariffs on the European Union from the United States? That 105 directionally, where does it go?
Well, I think that that's the sort of thing that can, makes me think that a move to 110 looks really unlikely, unfortunately. It anchors us. That's where we've been for a long time now, is anchored with a very cheap very cheap euro and a very expensive dollar. We get a focus on the tariffs on Europe, and we get growth concerns coming through. I think that just keeps us in a range. If I want euro dollar to go back to that 113 level, that it's the highest it's been in 2 years, I need some signs of growth, helped by easier fiscal policy, but helped by anything. I just need some growth.
What about a peace agreement? Would that do it?
Yep, that would do it. A proper peace agreement would, particularly if I've got a peace agreement with an agreement that we're going to do some investing, that we're going to walk back some of this ridiculously tight fiscal policy, or that would be a massive game changer. I mean, deregulation in Europe would be another game changer. But so I can see things that could change it. I do not have those yet, unfortunately.
Kit, plenty of headline risk on the horizon. Appreciate your time, as always. Kit Juckes there of Societe Generale. Everett Eissenstat, the former NEC Deputy Director, writing business must brace for unpredictable and choppy waters over the next few months as more actions are likely to come. Everett joins us now for more. So Everett, walk us through what you think happens here, because there are some people, a lot of people watching this program right now who don't believe the tariffs that went on overnight will stay on for very long. What's your message for them?
I think they will stay on. The president had an opportunity to delay these tariffs again. He decided not to do that. And so unless there's some sea change in how Canada and Mexico are dealing with the fentanyl crisis that satisfies the president, I don't see immediate relief in the near term. So I think the tariffs are on for a bit yet.
Everett, speaking to some sources this morning, what I hear from them is they want more private sector growth, less public spending, and they want manufacturing back to the United States. But how does that work with a very intricate supply chain when it comes to an auto sector, and already that's under a trade agreement of USMCA?
This is pretty incredible, honestly. I think to see such a rapid change in the market so quickly with two of our largest trading partners is going to impact a lot of companies in different ways. And some companies may be able to absorb those tariffs or put them, distribute the costs throughout their supply chains. Others may simply not have any choice and may be forced with actually thinking about moving to the United States. And I think the president has a mindset that he's going to do everything he can to facilitate more manufacturing investment in the United States. So the tariff actions seem to be part of a larger picture of deregulation, investment incentives, and perhaps tax cuts to draw more manufacturing back to the United States. So this is the first part of a very long story, I'm afraid, but I think we're in for, as I said earlier, some choppy waters in the near term.
I was reminded by another source very early this morning that in Trump 1.0, a few months after some tariffs went on, there were exceptions. Do you expect that to happen this time?
We'll have to see. There are some products that we cannot get in the United States. We simply don't produce them. And so for those, I would think it would seem to make sense to include exceptions for those products. There's really no reason not to. But I think we'll see. Another thing to keep in mind is on top of the tariffs that went into effect last night, we've got the steel tariffs that are going to into effect on March 12th. And those are going to be broader. They're going to cover more products. They're going to be difficult to administer. And over time, as these begin to resonate throughout the economy, I think there are going to be calls for some exceptions. Even if we've got exactly what the president wanted, which is to get all manufacturing back to the United States, it simply can't happen overnight. So at a minimum, it would seem that a delay to enable some manufacturing to come back would make sense. To date, we're not seeing that, but we'll have to see how these tariffs, as they resonate throughout the economy, what kind of feedback, members of Congress get and others in the administration about how they're being implemented. I'll just note that there was as you might recall, there's a de minimis exception for products coming into the United States duty-free that they're under $800. They're able to enter the United States duty-free. The president had taken that de minimis exception away, and then when the Congress and the Customs tried to administer it, they couldn't do it. So they had to walk back from that. I don't know if we'll see something similar, but we may see that in certain sectors for certain products.
Hey, Everett, got to leave it there. It's good to catch up. Eerett Eissenstat there, the former NEC Deputy Director on the trade effort in Washington, D.C. This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.